Good evening, everyone. Good evening. My name is Adam, and I'm one of the traders and analysts with Trade with Precision. Tonight's topic is learning to understand volume. Who is buying what? First of all, please can I do a sound check? Just make sure that you can hear me. Everything seems fine on my side. Green lights. I always have to do this because you'd be amazed that the one day that I don't do it, you can't hear me. So if you could do me the kindness and type into the questions box, just give me some feedback, and then I'll know it's all working. Great, thank you, Jack, appreciate it. And great, I can see there's still people entering the room, but that's fine. As you come in, it all makes sense. So again, the topic tonight is who's buying what. My name is Adam, and I'm one of the traders and analysts with Trade with Precision. So there's a risk disclaimer, and I want to give you a moment to digest it. While you are doing that, I'll tell you a little bit about myself. So I'm based in the city of London. I'm in South London, and I am a trend trader, so price action based day trading. I also do swing trading when the markets are kind of all up for that, so that's works well. And I am so trend-based trader, price action, predominantly technical trading, trading a lot more intraday lately than end of day. I enjoy it. I enjoy it a lot. I've been finding it it's been good fun lately, and it should be fun. If it's not fun, there's something wrong. But also, I used to do a lot of end of day trading. So that's the only difference is now I'm trading the 15-minute chart, whereas I would usually have been trading the daily chart. And that's it. Okay. So on the agenda for this evening is, first of all, we're going to talk about how to add the volume indicators to your graphs and charts. So we'll be doing this on the MT5 platform, and how to read the volume for assets and how to identify potential trades. So we'll talk a little bit about strategy here. I think that's important, and also talking about identifying strong volume and weak volume. So I want to include momentum. I want to talk about reading momentum into price action, and divergence, convergence, which is very powerful, especially when used in conjunction with this. I also think we could, I've got some recommended reading at the end, so if you remind me when we have the Q&A session at the end, I will have a look into, I'll send you a link for the book. So let's go across to the platform. We'll come back to this when we can, and let's have a look. So I've just brought up the platform I'm going to be using. I'll use the MT5 platform now. Listen, I should also just quickly add that as we're speaking, so for the next, let's call it 35 minutes, there's quite a large news session sort of going on at the moment. If we quickly go across to my browser, right now as we speak, we've got FOMC. This is the central bank in the US. The Fed also, they want to talk about their Fed rate, so we need to have a look at this really, because right now, and again, just for the benefit of those of you who are new to this, right now, as you may have heard, the world is kind of concerned about inflation, which is largely triggered by COVID. In other words, interesting to see how the steps have unfolded. Because of COVID, people have started working from home. They've also been able to negotiate better salaries, and also people have kind of shuffled their jobs around and also decided to spend a bit more money on their house or travel or holiday. And so this has triggered a bit more inflation. We've also got Russia invading Ukraine, which has created obviously food issues to do with food shortages and natural gas, as well as energy kind of crisis. That's really where a big chunk of that is. But also Ukraine is produces a large, one of the largest producers, wheat kind of farming grounds outside of the US, so they contribute to bread, ironically, kind of the price of bread, but also things like sunflower oil, as like 40% of the world's sunflower comes from one little country. So they're incredibly rich in terms of skills and natural resources. And so the US, so we've got this kind of high inflation rate, and the fear is this has kind of triggered a market correction. So again, I'll go back to the market here. We've had quite a large correction. If we have a look at, say, the S&P, so here we go. We've had, let's go to the weekly chart. That gives us a really good sense of kind of how the market's been doing. Had a big correction. We really needed one. It was really important that we get one. So if you look at it from a monthly perspective, you'll see that we tend to originate, our moves tend to originate from the moving averages, head out and then come back, and head out and come back. And this was, COVID, we had this strong correction here, we recovered. And since then, we've had a really strong, aggressive streak in the markets. Okay, so I'm going to move on to the volumes in a moment. I know sometimes I always seem to start off left hand, sort of stage left, and take it from there. But the main thing I wanted you to see from here is the angle. The angle at which the market is moving is sort of very steady, sedate, kind of 30, 35 degrees. And then it sort of accelerates and it starts going up to sort of 45, 50 degrees. It's quite aggressive. And actually, when this happens, we call it going parabolic, and usually there's a correction as a result of that. And so we're having a very much needed correction because this is not natural. And so when that happens, we need to have a correction to bring it back in line with the overall direction in which the market's going. So the increase in the, when we have inflation getting out of control, usually the bank's central bank will then introduce rate hikes, which usually is a cue for some of the institutions to start offloading their positions. We see a bit of a correction, and actually initially, so if we look at where we are now, we are starting to see it cool down a little bit because it could have gone out of control. But there's a danger that the longer we do this, because if you may recall in the last few months, a lot of companies have been posting record profits. And so the thing is that the longer we leave this, the longer we, the more time we have in these lower areas in relation to the highs, the greater the risk that these companies will eventually have to give back some of those profits, and then of course have to post losses, and then they'll have to lay off people, and then it triggers a recession, and then people are out of work, but then inflation costs are still high, and then there's real problems because then people's mortgage payments, the interest rates have gone up and they can't pay them because they've lost their jobs. And so where we are right now is a kind of a sweet spot where hopefully it'll cool things down, but there won't be any really, really negative consequences. So it's just something we have to keep in mind. But also the worst case scenario, according to say Ray Dalio and Michael Burry, is they were halfway done if this is the case. That's a worst case scenario. So in other words, they're assuming that we could go, potentially as far as this on the way down, so possibly somewhere between that low and that low, and that would be, and then we would ultimately recover from that. That's the thing, right? Inflation and recessions are a normal part of the cycles of the boom and the bust of the markets, but generally the markets tend to go up and then they go down. So I just wanted to bring that in to say to you, look, right now as we're speaking, this is actually occurring right now. And I want to see what the kind of scenarios there. Did they have to increase the rate? They've kept it. Okay, so they've the forecast was 2.5, meaning that is what they've gone with. So you can see that's what we were before. They've gone up quite a bit. That's a 75 basis point hike. Usually when we get an interest rate hike like that, we do tend usually to get a stronger currency. So this implies that we're going to get a stronger dollar. So let's go across and have a look, because at the same time, eventually a market, any market, can be too hot, so it can be overbought, not in terms of the indicators, but in terms of price. You can get some of your most positive, exactly as we did, companies posting record profits up here before the correction. So you could also get higher interest rates and a strong dollar, and eventually the dollar there's no one else buying the dollar, and eventually it has a correction, even though the interest rates have gone up and it should be getting stronger. So let's go ahead, let's have a look at that. So we'll go straight through and have a look literally in the last hour what's going on. You can see here that the euro is strengthening currently against the US dollar. Okay, if we have a look at that, euro US dollar, we can see that. And if we go across and also have a look at the dollar index over here, you can see that this is a 4 hours. So let's go to the daily, just so you can see the dollar index, which we don't always have access to. You can see it's been strengthening for a while. And has had a bit of a correction because it was a little bit overpriced. It's trying to carry on, but this is where it is right now. So what the market is trying to process next is, you'll see next in the calendar. So again, this is for the benefit of anyone who doesn't know what I'm talking about now. So then you have the press conference. So you've got that happening. And really, following the outcome of this, the next thing the market starts to do is watch out for what's the language that's being used during the press conference. Basically, they're looking to see if the Fed are scared. Are they nervous? Are they calm? How much more do they expect they're going to have to rate hikes? What do they foresee? Have their projections got worse or better? That's really what it's about. And so right now, the markets are super sensitive to that. And if by the time we wrap up the webinar, if we see that the dollar has climbed, that would imply, without even having listened to that conference, it would imply that the markets got spooked. All right, or it would imply that they're expecting they're expecting the dollar to continue, rate hikes to continue in the future because the dollar is getting stronger, and therefore we can reverse engineer back from that what the implication is. Really, anyway, so there you go. And that's kind of what's going on at the moment. And I bring this up because it's the big thing in play right now. There isn't always something going on in the news, but right now, inflation, the war in Ukraine, those are the two biggest things going on. So I wanted to kind of walk you through that and say, obviously, some of that will translate into other countries. So that is relevant to what we're covering tonight. Let's go back to the platform and let's have a look at this. So next up, let's go and we'll start off with euro dollar here, and we'll talk a little bit about the indicators. So the indicators that I have on here at the bottom, I've got the MACD and the RSI, and I use these. Again, most of our decisions should be made based on price action, which is candlesticks. So if you are new to trading, we've got kind of two avenues of thought. You can either do fundamental analysis, which is very powerful when it comes to longer term calculations. Where do we expect the market to go over the next few months, possibly the next few years? That's very powerful, especially when it comes to stocks. It's really powerful. When it comes to economies, it's very tricky, because you could look at Europe and go, I think Eurozone has a really strong economy, but you then have to look at the US or the UK and compare it and say, well, I think the UK economy is going to be stronger, and therefore you would have the pound still strengthen against the euro, even though you've just said the euro you expect it to strengthen. So Forex, in terms of fundamental analysis, in my experience, even when I've rubbed shoulders with bigger institutions, they're generally, I don't think their performance is as good in currencies as that is with commodities and stuff, because there's fewer cogs in play. But having said that, with technical analysis, what we're looking at here is much more shorter term moves within the markets. So just something for the next few hours, for the next few days. That is all I am concerned with. So if you think about it like this, imagine that we are looking at a daily chart. I'm going to draw here. So imagine I'm looking at a daily chart here. So the daily chart is trending higher. So the bigger moves we'll call extensions. You get an extension, retracement, extension, retracement. On the way down, you've got an extension, retracement, extension, retracement. So the extension is the bigger move in the direction of the prevailing trend of where the way the market's flowing. Let's call it that. So the thing is that although the trend is going to the upside, and this is a daily chart, these areas imply, if you had to zoom in and you had to look at it on a 1 hour time frame, your 1 hour chart would sort of do these highs and lows, and then there would be a temporary 1 hour downtrend or 4 hour downtrend when the daily is correcting. So the point is that if I'm only looking to trade the 15 minutes or the 1 hour, I was trading during this period, and let's just say that this was that's a Monday and that's a Tuesday, and that's Monday, Tuesday, Wednesday. Tuesday and Wednesday would be days when I'm probably selling that particular currency, euro dollar, whereas Monday I would have been buying, because on the lower time frames there's a trend to the upside in line with a bigger trend. Then would there be a bit of a correction to the downside, and here I'd be selling. Does that make sense, guys? Can you give me some feedback here? Amit, sorry, I beg your pardon, Amir, the lesson is being recorded. I will give you my email address. We'll do this, but just let me know if that makes sense, guys. I will give you my email address up here. Trade. So you'd be amazed. I do this every time and only a few people ask for it. So trade with precision. Okay, trade with precision. Take out the gaps. Make sure it's one word. tradewithprecision.com. Send me an email address. Send me an email saying, please, can you send me a copy of the recording, and I will do that for you. Okay, I usually do that. Out of a group of like 80 people on a webinar, I usually only get about 2. So it's a good way to make sure to see who's kind of committed to it. So I'll come back to that in a moment. Okay, so does this make sense, guys? Is what I'm saying here about, Monday being on the lower time frame, if this bigger picture of the daily and the lower time frame's got its own little highs and lows and extensions and retracements, on the Monday I'm going to be buying during the day, and on the Tuesday it's probably going to change halfway through, but then end up finishing the day going down, and Wednesday for sure I'm probably selling. So for day trading, you have to understand that you're trading within the higher time frames, bigger moves. And please understand that those smaller things have nothing to do with the fundamentals per se. Small noise on the lower time frames isn't, when you think about it, shouldn't really contribute to the bigger fundamental picture. So let me re-say that, because it's really important. Let me repeat it. Smaller noise on the 5 minutes or the 1 hour shouldn't really be considered important to the bigger fundamental analysis. It's just noise. And actually, you can reverse that by saying that smaller moves on the lower time frames are not subject to fundamental events. They're not. They're just noise on the lower time frame. So what we're doing is we're trading the noise. We're trading the smaller moves given throughout the day, either in line with the bigger fundamentals or temporarily against them, because there's a bit of a correction. So it's really important to understand this, because if you cannot exclude your fundamental bias, your bigger picture bias from a trade for the next hour, you will find statistically you probably have more losing trades. So the best day trading results, or trading the lower time frames, come from looking at the day in isolation. This is it. This is a big secret. Whether you believe it or not, I'm going to give you this, or just tell you this. It's not a secret, but it's secret because it's obvious and no one believes it. You look at the markets as they are today, and you trade in line with as they are today, and then tomorrow you start again. Now they might be going in the same direction, but you need to take a fresh approach every day. So having said that, because we're going to talk about strategy and volumes and everything. So yes, so there's a great comment in here as well. The trend is your friend. Fantastic, it is, but this one is fantastic. This one's important. So the higher time frames carry more weight overall trend wise. So what does that mean? It means that actually, as often as possible, if I can trade in line with the higher time frame in the same direction, the probabilities of me making money or the trades going in my favor is as good as it can possibly be. So although and let me use an example of that. In this case, the daily trend is going up. So actually, honestly, as often as possible, if I can trade to the upside, let's say my 15-minute trend is trending up and my 1 hour is trending up. That's fantastic, because I'm going in the same direction as the 1 hour. I just wanted to highlight, and this is where sort of more experienced traders come in, is during these periods, which can honestly last as long as 3 or 4 days, there could be some high probability trades to the downside. But keep in mind that the experienced trader knows that it is within the bigger picture. They know they are, but it's calculated. It's calculated. They can see that it's coming back, and they're taking calculated positions, temporary positions against the higher time frame. So this is important because again, we could be doing that. So here's, so that's all I really wanted to talk about. And that's why it pays to look at each day in isolation, because if you were buying here, up here, but the market's now going down, and you decide to buy, you're ignoring the fact that the market is now going down. So this is something we all have to just kind of build into it. So here's what I wanted to tell you about these 2 indicators here, by the way. I use 2 indicators as a double confirmation. I'm going to talk about momentum trading now. Then we're going to get to the volume, because you need to know about these with the volume indicator. What I want to do, what would be first price for me, is that by the time this webinar has finished, I have clarified a lot, as much as is possible for you, and given you some very highly reliable information. Not something that's 50-50 or 60-40, so stuff that's like 70, 80, or 90% reliable. That's really what I want to do here. And so first of all, you need to also understand that less is more. When it comes to trading, having less on your chart is better for you. If your chart's got too much stuff on it, you will suffer from analysis paralysis. Even the best trader would if you put too much stuff on the screen. So we have 2 indicators here, and we are going to use them both the same way. The mathematics between them is very similar. They're kind of cousins of each other. And we're going to use them as momentum indicators, right? Which is a form of using them as a leading indicator, which we'll talk about that. Because this effectively, the MACD is made up of basically moving averages against moving averages. It's heavily derived from price action. So we call it a lagging indicator. But we're not going to use it that way. We're not going to use a moving average crossover. We're not going to use the histogram. We're not going to, very important, we're not going to use oversold or overbought. All of those approaches, although I know how they work, in my opinion, and not just my opinion, they are not as reliable as the way in which we're going to use them now. Here's where you get the best out of it, as well as the RSI. So RSI basically, we're also going to ignore the oversold and overbought. Okay, so this is how it goes, and we need a really nice chart just to illustrate it. We can do it here, but we'll go to a better one. There's got to be a better one here somewhere, so we'll pick something else. So let's pick dollar yen. Okay, we'll pick dollar yen. Okay, we'll go with this for now. Okay, so the two indicators must be used the same way, and what we're ultimately going to do is we are going to compare, because a trend, by the way, a trend, if we use a wavy line, a trend is made up of highs and lows. We've got these higher lows over here and higher highs over here. So even here, you can see, if we kind of remove it, there's a low. We could see it bumps up, there's a bit of a high, and then it comes down here, and then it goes up there. So we've got a wavy, if I exaggerate it, we've got highs and lows. So generally speaking, if I look at this now, I can see that I've got a series of high lows going up and a series of higher highs going up. This is trending up. Cool. If I oversimplify this, so if I sort of do this and do that and do that, we're generally trending higher on the RSI as well. So both of these indicators currently are giving me the same signal, the same story. And also what we want to do, ladies and gentlemen, is keep it fresh. I'm only really concerned with what's happening here because this is fresh. Anything beyond that is not really that relevant because the market will go from trending upwards, trending downwards, sideways, all kinds of different things. And I want to make sure that the current signals I'm getting and current price action, because I'm going to get into a trade here, make us are sensible. I mean, are in agreement. So here's what happens. When we have a trend, an uptrend on the MACD and an uptrend on the RSI, they can be regarded as bullish. Forget about looking at the chart just for now. I'm doing it back to front. This is something I'm going to check at the end, but I'm talking you through the explanation now. If these are both trending up, they are bullish. Okay, got to put a BU there because when we do bearish, it's a BE or something. When both of them are trending down, they are bearish together. It's better to have two. We could, if somebody stuck a gun to my head and said, you have to pick one, then I'd pick the MACD because RSI can sometimes give false signals. But if you use two together, it increases. Because remember, what I'm trying to do here is increase your confidence as well. I want you to feel that, okay, if I apply this, the market should tend to do what it says it's going to do more often than not. So when we have a trending down and trending down, it's bearish. So this is important because if these two are bearish, and I'm going to go roughly from where they're bearish, there, roughly to where it finishes, somewhere here, come on, there. What I'm looking for, guys and girls, ladies and gents, is for price action to do the same thing. So I want price action to be bearish when the indicators are bearish. Or another way of putting it is I want these indicators to be matching what price action is doing. So if price action is bearish, I want my indicators both to be bearish as well. If everything is in agreement, in other words, price is bearish and the indicators are bearish, then what that tells me, okay, we'll go to the notepad as well, is reading momentum, momentum indicators. Okay, 1, confirm a trend is strong. Oh man, what is wrong with me? Strong. It's been a long day, by the way. My trading day starts at 6 and then I run till late nights. And I think from next year, I might not do any evening. I might stop doing webinars. We'll see. I love it because it's the only time I get to talk to people, but the long days are kind of taking strain. Confirm a trend is strong or healthy, or warn. This is what we use it for, and this is where the volume is going to come in as well. Warn that the trend is showing, wow, I can't do a single word right. Caution. Or was it caution Will Robinson? Something like that. Maybe don't trade. Or, yeah, trade with the trend. Maybe don't trade. And 3, there may be a change in trend soon, comma, which means wait for new trend and then take a trade. This is really important. If you can screen grab this. So these are the 3 things that the momentum indicators can tell us. First of all, they can tell me when I want to get into a trend that the trend is strong and healthy. So let's talk about that. When price action and the indicators are doing the same thing, I have got as many green lights as possible that the trend is healthy. If we'll go, I'll just do this one. We'll just do it. Can I move this stuff? No, I can move it away somewhere. I'm trying to create some space here. So number 1 is if the trend is healthy. That means that if my trend, my price action is going up and both of my indicators are trending up, boom, the trend is healthy. All signs point to it being good. There's no, because of course our biggest fear is we get into a trade and that's the end of the trend. Very nice. So the second one is that price pull back. We're looking to get into it, but the indicators have started to trend. Both indicators have started to trend down. So they are bearish, but price is still creating fresh highs. So we have divergence. Okay, we have, this is bearish, so we have bearish divergence. And same way on the way down. We have a really nice trend in price like this, and it's pulled back. We're thinking of taking a sell here, just like we were thinking of taking a buy here. And the indicators have started to trend up. So again, they are bullish, so it's bullish divergence. Or 3, so this is maybe don't take the trade. The risk is higher. The market is running out of steam. Consider not taking the trade or consider reducing the risk. Those are your options. Number 3 is the same thing, except we might be waiting for price. You see now this is trending down and this is trending down, but this is not trending down yet. We need, and this is crucial, important, emphasize it, must have price shift from an uptrend into a downtrend. And then we can look for sells. And then we're looking for sells and this is trending down. So then everything's in agreement because price has now followed through on the indicators. So those are the 3 ways in which we can use it. So what we're going to do here is we're going to apply this with volume to help us. Let me look at your questions. Why does it make sense on intraday to buy on Monday and sell on Tuesday and weekends? You know, a lot of the 80s and 90s, a lot of the 70s and 80s technical traders talk about weekends being one of these things where on the weekends markets tend to, people have had time to think about the positions they got in on Friday. And sometimes they get panicky and they reverse. On Monday, you see the market just reverse on what it did on Friday. And then sometimes Tuesday comes up and they go, why did I do that? And they get back in on it. And then Tuesday starts to pick up. So it's usually because the weekend gets into panic. Now, cryptos are the only thing that really runs through the weekend. So cryptos are influenced currently by equities. So equities are influenced by people, who can't trade on the weekends, who've made their decisions on Friday, maybe panic on Monday or Tuesday. And then that obviously cryptos will do their thing during the weekend, but then generally on Mondays they'll align back with, or be, there'll be a layer of another influence from equities from that. So let's go and let me show you this. So let's go back to euro dollar or sterling, and let's go back to that daily. Or is it even the 4 hourly? And I want you to see a few things here. So let's just quickly confirm that everyone's comfortable with this. You can see here, price is generally in a downtrend. Okay, it's coming down. There's a low here. But interesting, because as you go from that low to that low, in fact, even as you go from that low to that low, you can see now that this has started to trend higher. And actually, so has this one. This is also starting to trend higher. I do sometimes I do sometimes pump that up a bit, so like 10, which will pushes up the peaks and troughs to show you that there's some, you know, potential. Let's have a look at push that in there. So you can kind of see it starting to trend higher at that point. Okay, and so what happens then is we get a change. So for example, a downtrend in price shifts by, it has to break a high and has to produce a high, low, high, high. So breaking a high, because the whole reason we put our stop loss behind these is that during these moments when the sellers take profit, the buyers try to push back, more sellers come in and push it down and they break it through here. So they push it further and then you get another, you get this ebb and flow, ebb and flow, ebb and flow. But generally the lower highs are where the sellers come in and overpower and keep pushing. At some point though, when the market breaks back up above that, then that tells you that the sellers that were here are not here anymore. And therefore the story might be shifting and the market will go through this. So we often put our stop losses behind these turning points because when the market goes through them, that should be telling us, listen, buddy, 99 out of 100 times, probably less than that, probably 95 out of 100 times, I think the market is now not going to go in your favor. I think this trend has run its course and it's going to change soon or it's going to change now. So that's how you then go. But also when you go from a downtrend of lower highs, low lows into an uptrend, you must have a low and a high and a higher low and a high high. So then it's reversing that way. So here, for example, you can see we're generally doing low highs and low lows. We come up here, we start to break through that, produce a slightly higher low, and then we break up here. So there's actually a whole lot of things happening. The market kind of is like this and then wobbles and wobbles and then breaks up like that. It's sort of a inverted head and shoulders. It's the same kind of behavior. Okay. So that's it. And on the way up, you go into a downtrend, lower highs, lower lows. So you need to go from there to there to there to there, and you also break that generally as that. So there's a whole lot of things that happen at the same time. So that's why if we see a bit of divergence, which is what we saw here, we saw this starting to climb and that starts to climb. The moment where it really kind of broke through that was here. It still came back down, but then it started to head to the upside. And so we started to see that happening. Okay. So when we see divergence, and also I think this is really interesting, and I've never heard anyone else say this, but divergence almost always occurs as we approach a major level. As we approach a major level, the traders start extricating themselves from their positions. They start exiting their positions and it starts to lose steam because when it gets to the level, they don't know if it's going to break through or bounce off it. Nobody wants to be caught on the wrong side of it. So they start to get out of their positions and it loses steam, and then we get that divergence, and then if it rejects it, that'll come from that. So when we see divergence as we approach a price level, it's a good indication that the market itself doesn't really know how it's going to react when it lands at that level. Okay, and so sometimes there's an opportunity for us, especially if the market is very overextended and it must come back. On the much lower time frames, we're going to see this. We're going to see a change into an uptrend, and then it's in an uptrend on the lower time frames as it comes back into kind of the moving averages. And so this could be your daily or weekly chart coming up, and there's your 1 or 4 hour going up, and lots of day traders will be buyers in that temporary window. But please understand that they know it's a temporary window. They know it is within the bigger picture. And so they will wait for that confirmation. They'll wait for it to go from a downtrend into an uptrend and start looking for the very first buy opportunities as they can on the way. So now that I've said all of that, let's bring in the volume. So you'll see here we've got a couple of different ones here. We've got accumulation, distribution, money flow index, on balance, volume, and volumes. And I think on a note on this, please, for whatever reason, whoever writes the definitions of these things are like, no offense to accountants. No, I apologize if I offend accountants, but it's as dry as it can be. I always find that the definitions don't help you at all. They just a whole lot of words on a page and don't really explain to you the context, like how would I use this? They just tell you, they give you the formula, like that's actually going to make sense to you. So a lot of these can be used the same way the MACD and the RSI are. The one we're going to focus on is going to be volumes, but accumulation, money flow, and on balance volume can also be used. So let's just bring it in here, just see how it looks. Here, we can also potentially get, actually what's interesting about money flow is almost the opposite. You'll see that we went down extreme lows, while price was going up. So it was the same idea. We've got divergence, prices going up and this was heading down. What it meant was if price is closing up, but the numbers are heading down and there's that disagreement, we have divergence. So again, using it for that purpose makes sense. Let's look at accumulation distribution as well and look at that beautiful divergence, like really good. In fact, I would argue that this is a clearer picture than RSI. And it comes in later. So notice it comes in here. It doesn't start creeping in here. I would argue accumulation distribution is right now in this case is a better indication of divergence than the RSI. That's really great. I really like that. So I'm going to get rid of this just for tonight, just as an indicator, and take that out because I think that was a great. I hope you guys agree with that. It just shows that divergence a lot. It's a lot more obvious. And then we've got on-balance volume, so let's bring that in so we can have a look at that. And again, that's same as the other one. It has a lower low, even though the market was turning around. It's actually similar to the money flow index. It's very similar. It will give you divergence the opposite way, but you can use it very well for that. And you know, it has a couple of, sometimes it has a couple of areas which will show some slight differences. But what we are ultimately looking for, and the whole reason we are here tonight, is to have a look at the main star, which is volumes, which brings in, we've got green and red. If we want, we can see volumes by tick or real volume. And let's just have a talk about that as well. So I wanted to show you the, we'll make it bigger and we'll keep these nice and small. Because I've shown you how we would use those and what we're gonna do here. We need to just have a look at a couple of things. So first of all, going down here, I wanted to show you this. So first of all, a green bar will indicate, no, that didn't work any better. A green bar indicates that the volume for that particular sessional candle was greater than the volume of the previous one. So what does that mean? It means that if you get a green candle here and the previous, means that this volume was greater than the previous one. So, you know, the red one here was less than the previous one. So you could take the color out. The color almost doesn't matter because if it's higher, it's going to be green. And if it's lower, it's going to be red. So it's a duplication. It really just means the volume is higher than the previous session. Conversely, a red bar indicates a lower volume with the previous candle. So let's just talk about something else here as well. We need to understand that one of the key differences between currencies and stocks, stocks are registered with a stock exchange. So if it's Facebook, which is now Meta or Apple, it's registered with the New York Stock Exchange, I believe, and it's part of the Nasdaq 100. It's also, I think, in the S&P 500, I think, sometimes in the Dow. So they might overlap in a few different indexes, but the point is they're registered and every single sale or purchase or transaction is ultimately tabulated and recorded by the exchange. So, and it goes through that exchange. So in some ways they like that because it means it's regulated. There's one final person, they used to call them clearinghouses. They clear it and there can be no duplication. But when it comes to currencies, currencies don't go through a fixed exchange because which country is going to host the exchange? So, I mean, Russia would love to, and US would love to as well, but no, you can't do that. So it goes through central banks, it goes through banks, hedge funds, institutions. The pro is that it's very transparent. You can open up your phone anywhere you want to go, open up a million different things. You'll get pricing through various brokers. That's the pro. So it's very transparent. Also very big. That's why it's the biggest currency market. The currency market's the biggest asset class in the world. It's bigger than all the other markets kind of put together. And that's why you got the liquidity. Can you get, could euro dollar be trading at a different price around the world? Yes, absolutely it can. Okay. There's a fluctuation, but it's anywhere from pipettes, which are a fifth decimal place, maybe to 1 or 2 pips difference. It's very, very small, and it's getting smaller over time because we are, the markets are, it's getting smaller over time is where I was going with this. Let me just check something quickly. I want to look at the dollar. That's good. Okay. All right. So we don't have that, but it's not a bad thing. It's just saying we don't have it, so we need to be aware of that. And I just want to see something as well. 12098 tiny units 12145. Okay. That's fine. I'll do it later. Okay. So that's a pro and a con. We also just can't. We can't. So it means yes. The only volume. Sorry. It means the volume that the broker can show us is their trading volume. They can give us a reflection of theirs. But for the most part, that must be pretty close to what every single other broker in the world is doing. So when we look at volume here, what we can do, and which is why I thought it was very interesting, was that it gave us tick or it gave us real, gives us those different values. But mainly that being that this, where we at? Let's just go through. This is what we get through the broker. So just be aware of those differences. And all it means is take it with a pinch of salt, but it's not a trick. It's not deceptive. We can use this in many cases. And really what we want to do is we want to see, to kind of get back to how we approach volumes. Volume can help reveal how much strength is behind a trend. So first of all, let's talk about how we see that in price action. I'm trying to give you guys a lot of master trader stuff here as well. When we see the angle is a good indication of the strength. So if this is going down like this, whereas prior to that, it was actually quite steep. So it's losing that strength. If we see this going up at quite a steep angle, it's quite strong. If it starts kind of running like this, it's losing strength. So the angle is one thing. We need to see very few spikes in it. So what I mean by spikes is that in this area, for example, we see a lot of spikes in that area. And actually over this whole area, there's a lot more spikiness than there is in this kind of area. So when we have less spikiness, the candles are full. They're actually, there's a lot more commitment in it, rather than ranging. And ranging tends to be very spiky. So you'll get ranging spikes. You'll get a lot more wicks and shadows, tops and tails and stuff in sideways moving markets. So we have that. Also, we want price on top of the moving averages. So when the moving averages are all 50, 20, and 10 are all kind of running parallel to each other and price is largely on top of them, that's a great indication of a strong trend. Not only that, but we would also, of course, expect both of these indicators, especially now I'm really liking this accumulation distribution, we would expect those ideally to be climbing with that. But most of our decisions should be based off this. If we know that the next major level is up here, and this is the last major level, generally price will flow all the way up to that. So we're not really worried until we get up to that level anyway. We would expect the market to kind of go up to that. Okay, and wow, sorry, market's just moving like crazy. I'm fascinated by it. So they've obviously said that they're happy with the way the markets are going. So we'll go have a look at the markets in a moment now. So next up, I obviously want to see an increase in volume. Okay, so here what happens if you go from here to here, you can see the volume is generally increasing. That means the trend is still strong. Now, would I take volume over these indicators? No. Maybe because I know how to use them, been using them for a while. I would rather trust these indicators first and take a look at either include all volume or just include these, but the volume can be great for that. So that's the first thing. Rising volume in line with the trend tells me the trend is still healthy. That's a big thing. Okay, that's a big one. So that was it. We have a rising trend and that still looks good. And again here, a little bit odd, we kind of had flat volume and then it dropped a bit. So that's interesting because now price is kind of doing this. We've got that conflict. And so you can see it's not as useful in areas where the market is largely going sideways. It's very powerful when you have a strong trend. So here, for example, even on the way down, we're still generally, if I had to draw it, we're still generally climbing on those volumes. So that looks okay. But for me, and again, here the kind of large even, not as strong of an indication. Now, the next thing that can be fantastic is an area like this. We've got a range area here, range area there. Look at that, pretty much range bound. And this period where it breaks out of that range, look at the spike in volume. Look at this boost in volume over here. So this is the next, and it's incredibly powerful, by the way, when you take this through to stocks. It's very powerful. A consolidation breakout is one of the most rewarding trades in stocks are very good, because often you can get like really big moves in the direction of the trend, and it's in the direction of the trend. It's not counter trend, it's always in the direction of the trend. So it makes it quite safe. When we get a breakout of a consolidation area, which is matched by an increase in volume, that is, I don't know the exact stats, but it's like a 90 to 95% stamp that that breakout is going to be successful. On the other hand, should we get an attempted breakout and there isn't a matching increase in volume, it's usually a really good sign that that breakout is going to lead to a failed breakout. Yeah, so again, let me just repeat that, because that is kind of what we do here. So again, a breakout from a consolidation period with an increase in volume is it's a thumbs up. It's like, great. We've got, and in this case, these indicators are useless. I mean, what they've done is they've prepared me possibly for a bit of a move, but that doesn't really help me. A consolidation breakout with an increase in volume is a really good thumbs up that that breakout is likely to be a successful breakout. And so we can often do that. So again, we want to be seeing a spike in volume wherever we can. I'm just wanted to have a look at this one here. Sorry, I was having a look. I had a trade on, which during the swinging around got closed out, and then of course the market's gone in my favor. I've got other trades open, which is fine, but I had a cable trade open at a lower price, and of course that one is closed out, which is a bit frustrating while the market's around. But I knew that that might happen. It was just, I just wanted to confirm that it had actually. So here I'm looking to see, is there perhaps possibly an increase in the spike? So it's really specific. I want to know at that point, is there? And actually here there isn't really necessarily a bigger spike compared to that. There is on the particular candle. If you want to go through and do it, then you can see if there's a particular, and you can do it right down to the specific candle. It doesn't have to be over a batch of candles. It can be to that specific candle. So let's move along and have a look at it, and say, for example, gold as well, we could do that, but I want to have a look and see what's going on with the Nasdaq. So let's go through to the Nasdaq, which by the way is producing a very nice bullish candle. So if you haven't heard me mention it already, the nice bullish candle here, we often get after a big correction, we can get a green candle, which can often lead to the next move up. So what may happen if we close, especially as a strong bullish candle for July, and August breaks the high of that, we could see the market trying to go back up to those highs. Okay, which actually means we might even see something similar on cryptos. Should we go see what's going on? There we go. So there's your boost on cryptos and your boost on these as well. We should be getting that. What's happening here? What's on our 4-hour? There we go. There's your boost on that. Now, the reason for that is very simply put, that cryptos are now part of the portfolios that big institutions offer their clients. Give me 1 second here. I want to place a trade. So I've got, we're at 21.24. I've got an, yeah, I want to just do this one. So I'm just going to go in at this one. Put this one in at that. Yeah. No, just go live, market execution. Yep, buy. Okay, and I want to get in on euro dollar. So let's have a look at euro dollar. And buy. Okay, there we go. I'll come back to those when I need to. Cool. Sorry, I was just like sitting and I'm going, I would have been trading this if I been live, so we'll just do this one. I've got much larger positions on these, so I've been trying to scale in. That's really what I'm kind of talking about here. And it's fine. If I have to stop them out, I'll stop them out. It's okay. So that's really where we do it. So again, let's go back to this one here where we have that volume. Let's go back to that chart and let's bring in a couple of the other markets. Let's bring in the stuff here and have a look at these as well. So look at this as well. Okay, look at this as well. We've kind of got, to me, I would say that's a declining volume, and we've got a rising trend, which actually means effectively at that point we have got it's losing weakness, but also we don't really get that volume until this candle's closed. Then we would get the volume for that. We can't get the total volume until it's done. Yeah, look at this big move down with the rise in volume. So strength of trend, but I like the breakouts. I really am keen on a nice consolidation breakouts if we can get an increase in that, and especially here there's a nice little bit of a spike in that. Let's go across to other instruments where possibly that is going to be done, which is a lot better. And so I want to have a look at, say, let's look at the Dow. So let's go across to the Dow. Let's pick that up, and you can see here just sort of declining at this point in time, but let's go down to the, there's your spike. Look at this. So this is on a 1 hour and you've got that kind of big spike in green. If we're going through a consolidation, this could actually be quite nice. Let's just zoom in and get this spread out a little bit here. And there's your kind of nice clear boost on that. Generally speaking, guys, bigger candles generally must have bigger volume. It isn't always the case. A small candle can have high volume. If there's a lot of activity and both buyers and sellers are fighting and pushing and pulling and pushing and pulling, and it doesn't go anywhere, but there can be a huge amount of volume. That can be an indication of a battle, and therefore there might be a change in direction. But it's very rare. The only situation in which you could get a big candle with no volume is like a currency crash, like a where you get where you get a flash crash and the market falls through orders. So you get a big candle, but there's no volume behind it. In fact, the reason it falls is because there's no volume. There's no orders, and it just kind of drops through them. But when you get a big candle, you can only, aside from that, those rare instances, it means big volume. Okay, so a big candle combined with a big thing can often be a big push. Now it's interesting. I was kind of brought up on the idea that I shouldn't trade big candles, but sometimes a big candle after consolidation or a big candle breaking through a big level is usually just the kind of horse breaking free, and then it'll start moving after that. So don't necessarily discount a big candle when it's breaking out or breaking through a level. Sometimes that is the thing that is needed for the market to then start moving. So just think about it from that perspective. Let's have a quick look here. Yeah, so you can see on that 4 hour that's starting to drop. That's looking good. Yeah, I like that. Just gonna delete those pending orders because otherwise I'm gonna get myself into trouble. There we go. Cool. All right. So yeah, it's dropping quite a bit. And actually, ladies and gents, this is, let's just get some perspective on this. Again, that monthly. Look at this monthly candle. Look at how kind of big that is. It's quite overextended. And so I think we might continue up, but we just need a bit of a correction back down to these levels or back down here. We need a bit of that, and we might not. Let's see what the market does by Friday, because actually right now all we're getting really is a weekly correction back down to about here potentially. So it could come down to here and then push on. This level that I've got here, let's have a look at that. So go to the daily, and you can see this is a level that's been holding. So if we break through that, then I think it's almost as close to guaranteed we'll head down to these major levels. So okay, cool. And then what we're really getting is we'll have lower highs, lower lows on the daily, but it's just a weekly retracement. It's just a weekly retracement at that time. We'll see. And please also note here again, look at the angle. Angle, steady, 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 parabolic, kind of. And so generally in those situations, if you draw a line right through it, like I do here, we might get a correction down to those levels. That's a possibility. I'm not going to trade on it. I'm going to, well, if I did, I'd need a good entry, and then I would be trading, obviously taking profit as we go. So let's have, look at that, it's going. I mean, these are major levels here. We've got multiple levels there. They're different colors because we've got monthly, daily, and weekly sort of in that area. So that's trying to get through those levels. Looks good. Look at that volume bar going as well. Let's go back to the notes that I made as well. Volume trading obviously is therefore similar to momentum trading. So you're looking to see an increase in volume behind an increase in the trend, and if volumes remain high or increase as prices move in the direction of the trend, we can infer that the trend is in good health. If volumes decrease as the price continues in the direction of the trend, this suggests that the trend is running out of steam. I quite like that. I definitely trust my momentum indicators, but I also would use the two of them here in this case. And of course, I was just talking about here about money flow and on balance, and that was just, I was just going to talk about those. So that's not really that important. But let's have a look, one more thing as well, to talk about some of these things as well. So if we go back and have a look at a couple of these markets, and again, we'll use the accumulation distribution and the MACD here to support the idea. Let's go back and have a look at the markets up here. So where the markets were potentially starting to top out, we'll go to the weekly one here. Let's have a look at that. And so this is where it gets, just to talk about those again, here you've got that higher highs. This is really the point where we're producing generally, the market is falling down. It's like it should be doing this, but it's doing this and this and this. It's like it's testing the lows when it shouldn't be doing that. So we've got that and that and that, and then here it tries and can't even go back up anymore and comes down and then breaks that. And that is kind of really where this is really that point where the market has now, that uptrend is pretty much now unlikely to go. Starting to do that, we've got higher highs here, so that's angling up, and we've got definitely a lower MACD here. We've actually started to go down there as well. I might need to magnify it, but we're starting to go down a little bit there. And so we've got that happening as well. And so that's really where we start to get that bearish divergence. But at this point, I think, you know, we are seeing heavy selling there to me. Like, in other words, that's lower than that. And if we take it as an average, sometimes you can add a moving average so you can get the moving average. But if you had to say, okay, I'm going to put in kind of level here to match that, you can kind of see that it's dripping lower. It's still a bit on the highs here. And this volume increase here is a last ditch battle. Let's just draw a line up. This increase in volume is because of fear and selling. So yes, you are going to get an increase in volume there because the market has started selling. They've started getting out of their positions. So yes, that makes sense. You've got higher volume on a downtrend, which implies heavy selling. That's it. Let me rephrase that. Let me repeat that. You've got a downtrend in price, an uptrend in volume, or an uptick in volume. That implies heavy activity, obviously, but heavy on selling. Okay, and then it kind of, look at it now, it's not really the same. I would say it's still dripping down, but not as aggressively. And also look at this. Look at this volume here. Again, you've got that. So you can use this on a 5-minute time frame. You can see it when you want to see where that spike is. We go back again to like 15 minutes. We can see there's that increase. But I think 4 hours is also quite a good way of doing it. It's struggling to get past that level, but it's trying. So we'll see how that goes. Again, we've got this waning kind of drop there. The accumulation distribution still looks fine. Not too much of a problem on that one. And look here as well, just, yeah, that general kind of decline. Did a little, just kind of generally doing that. So to me, this says to me, especially if you do this, not as much selling at this time as there was here, or as activity. So there you had a bit of a push up, there you had an increase in volume. Now it's kind of stabilizing. So for me, this kind of really says that this whole area right now is in flux. It's not necessarily selling, it's not really buying, and therefore, again, this is where it gets tricky, is because if you're not seeing volume movement, what are you supposed to do? And obviously the goal is that, yeah, you are supposed to try to read into that. So this is why most of my decisions are based on price first, and then looking to that for an extra. Let's look at Tesla. So let's bring Tesla on, and you can see here for this we should be getting excuse me, relatively accurate data. Let's go ahead and have a look at that. Pretty steady on it, nothing big there as well. You can see on that daily here, yeah, not really getting a lot in there. What's with Apple? Very, very steady. Not so much. I'm getting more information out of these indicators, but I do like it. If there's an additional spike, I would consider that a massive stamp of approval from the markets. Okay, here you've generally got it climbing pretty steady both ways. Here it's kind of just steady. In other words, what I take from this is that I'm better off at this time just reading it. If I saw a spike, I pay attention to it, but right now I just trade in line with it. So in other words, here it's not really dropping. I don't think aggressively. I'd be buying. It still looks good at this time. Selling still look good here. Now we're in a buying phase. I mean, yeah, it's dropping off a little, but not so much, not in an alarming fashion as far as I'm concerned. And I'm really trying to be, I think I'm being generous here, you know. I don't really see that as a bit of an issue. And if I align it with where the beginning of the up move is in this area, we're fine. So again, I would look, it's dropping off a bit here, but again, there's not very clear signals from that, whereas these are bullish and those are bullish and that's bullish. So for now, I should be continuing up with that. Does that make sense, guys? So there are, you know, some really good ways of kind of going through that one. Volume confirms a breakout. Yeah, would you argue it's a lagging indicator to some degree though? So in a case where I saw a candle breakout and it closed and I got a matching spike in volume closed, I would take those two as a confirmation, because sometimes you can get a breakout big candle, and the next candle reverses back in. So price action alone wouldn't be enough, but that volume spike should be a confirmation that it's a successful breakout. So in that situation, I would see that as not as a lagging. It's definitely not a leading indicator, but it's kind of, it's doing exactly what price is doing. I would see it as a confirmation. Yes, but we're supposed to see it as a leading indicator here if we see price, you know, if we go through this and we see that volume dropping ahead of price. But we're not getting a lot of that data here as well. We're not getting so much of it. I'm getting better readings when I look at these. From here to there, I'm getting that bearish divergence up to those equal highs. I'm also getting it here as well, starting to trend lower. So with these, I think that they give me they're a stronger leading indicator of a change, of a potential shift, whereas I would use volume as a confirmation, if that helps. That's how I'd go ahead and do that. The AD on euro dollar on 5 minutes and higher, do you think we would see a trend reversal? All right, because we're going to wrap up soon. Obviously, I know I enjoy this too, but we're going to go to this guy, 5 minutes, 15 minute, whatever. Where are we? Sorry, I have to do this. That's interesting. So we've got that volume spike and it's sort of coming back down a bit at the moment. Let me have a look at the bigger picture here. So what does the 4 hour look like? So this is kind of dropping down. You know what? It's really interesting. How many of you are familiar with sort of bear flags? So you get a bear flag basically is when you have, sorry, a bull flag. Price is trending up, pulls down, and this here can be called a bull flag. So you kind of, you get the breakout. So there we go. So if we get a break above that trend line, it would be a continuation to the upside. So that's why I'm really interested to see how that finishes. I've got a little bit of clock here. Where's my candle countdown clock? There we go. So we've got 2 hours until this candle finishes, and I would say it could fail. That could be the case. If that is the case, then fine. Then it's going to be a failed attempt to move to the upside. But so far, most of the markets are continuing to push a lot higher. What does that 1 hour look like? The 1 hour's, there's no trend at the moment. Look at this nightmare that we had yesterday and today. Here we just broke into the upside. We went to a low, we broke into the upside. This is still called range trading. So what we need, guys, is to see if it's going to go up, we need to see it settle into high lows, high highs. So we have no trend. We're waiting for a trend. Should it come back down and start trending down, then we've got a downtrend. And should it come back in here and start doing this, and we're still within the range. So in other words, you now have to wait for the market to pick a path. Which way is it going to go? So when it starts trending, then I'll look for buy entries. When it starts trending up, when it starts trending down, but it's still, I would argue, let's go zoom out a bit. I would argue that it is still, that's a range. And that's a bit of a range there. I'm just going to include this in it because that's a bit weird behavior. So this is my range. So probably once we get above that, we'll trend. And if we come back within here, but if we stay within this area, we're still range bound. So in answer to your question, do we get a trend reversal? Yeah. So it depends which way you see that. This is range bound now. So yeah, I would see it from there. But look at that spike. I mean, go Tigers. It's really trying, isn't it? Okay, cool. What else? That's it. Any other? Yeah, and you can see other things climbing as well, natural gas and a few of these other things. We are running over, guys, so I'm sorry. But I did want to cover as much as possible with you on this. There we go. So shrink that down. Again, for me, an indicator, if you add it, it really has to give you like bang on value. So again, as I said, the way that I would regularly use volume and trust it would be on stocks and on breakouts. That's where I think it adds the most value. But really as a confirmation for trend strength, although it can do it, I would have thought some of the other indicators with the single line ones, not the bar charts, or giving kind of more reliable kind of. So you can have all three up there. You can have your volume gives you that extra bonus, that extra tick in the box, and the other indicators showing you more momentum. Ladies and gents, it's an absolute pleasure. I'm going to give you my email, and there's a couple of you that I've seen your request for the recording. You should, when I post this in, everybody should get it. But I will. That's my plan. It is being recorded, and if you can just send that to me, I'll send you the recording link first thing in the morning. Should get it tomorrow. Okay. And that is it. So I was going to say to you, look, if you have any questions with regards to platform help or your account help, please get in touch with the lovely folks at IC Markets. Obviously, they're very keen to assist you in any way possible. I look forward to always seeing you guys in future webinars. Please don't be shy. If I'm presenting, if you have a question and I can answer it and you thought of it between webinars, write it down, just bring it with, and I will do my best to answer it, even if it's not necessarily topical to what we're talking about. And if there's a specific market you want me to have a look at, just shout, just let me know that one. Okay, cool. So I've got a couple of email addresses here. Thank you. Yeah, and that's it. Also, yeah, in terms of that, great. We're all swapping emails now, are we? Okay, so that's it. Thank you very much. I was going to say thank you very much. We're running over a little bit, and I'm worried about that. I want to make sure you guys can get back to your loved ones. Yeah, so that was really interesting. It'd be interesting to see what the Fed has said about the stuff, because the price action is saying that the dollar is just tired. They may have come back and said, you know what, we're going to keep raising interest rates. And if the market still gave us a weaker dollar based on that, that gives an indication of how the market is tired of a strong dollar. So, you know, there's a lot you can infer from it. But remember, for day trading, we're just going to trade in line with what those, we're not going to worry about where the market's going to be 3 months from now, because 3 months from now, we'll be trading the same direction as the market then anyway. Amir, please just do me a favor. Please email me and ask me about the other ones you want, and I will send you the links for all of them. Okay, especially if you can give me an indication of when that was. If you give me a date, like even within a few days, I'll do it for you. All right, guys, thank you very much. I'm going to exit now and say and wish you a wonderful evening. Thank you very much. I look forward to seeing you in future webinars. Have a good one. Thank you.